Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm going to start the problems on receivables management. One video already I have uploaded on the theory regarding what is receivable management, what is the importance of receivable management in a business, and how to evaluate the proposed credit policies. All these things I have already explained in the theory video. Now in this video, two problems I am going to explain how to evaluate a proposed credit policy. So without understanding the theoretical concept, you should never go to understand the problems. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject Financial Management for BBA, select the video of Receivables Management Theory Explained. Watch the complete video, be thorough about the concept, clear about the concept, then you can easily understand the problems. So before explaining the problems, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep ready the problem. Take the screenshot of the points which I have written on the board, then I'll explain every point in detail. Come on, see the first problem. A firm decides to liberalize credit to increase sales. Liberalize means lengthening the credit period. For example, presently the credit period allowed is 1 month. They want to increase it to either 2 months or 3 months. That is called liberalizing the credit period. Extending the credit period. Why credit period is extended? In order to increase the sales. Because customers wants more credit period. For example, one business allows 1 month period, the other business allows 2 months period. So normally the sales of that business which gives 2 months credit period, there the sales will be more. The customer want more credit period. But there are advantage as well as disadvantage of extending the credit period. So here the firm decides to liberalize credit to increase sales. The liberalized credit policy will be an additional sales of 3 lakh. That means if the company liberalize the credit policy, the additional sales will be 3 lakh. That is the benefit. The variable cost will be 60% of sales. Actually, two costs are there, fixed cost and variable cost. But fixed cost we will not consider, because even if we extend the credit period, the fixed cost will remain same. The fixed cost is irrelevant for our decision problem. Only variable cost we consider. So 60% of sales is the variable cost, and there will be 12% risk of non-payment. Risk of non-payment are nothing but bad debts, irrecoverable debts. There is a chance that 12% of sales will become bad debt. And 5% collection cost. That means if we liberalize the credit policy, two costs we are incurring. One cost is collection cost of 5% we have to incur, and 12% is the bad debts we have to bear if we extend the credit period. Will the company benefit from the new credit policy? The problem is we have to evaluate whether there is a benefit from this new credit policy. Now we evaluate. We'll see whether we'll get the net loss or net gain by adopting this new policy. See here, evaluation of liberalized credit policy. So first of all, additional sales. In the problem it is given, if we increase the credit period, additional sales we are having 3 lakh. From sales we subtract variable cost. It is given in the problem 60% of sales. So 60% of 3 lakhs, 1,80,000. Subtract sales minus variable cost. You will get the contribution. That is the benefit we are going to get. Cost. One cost is collection cost is 5% given in the problem. So 5% of sales, 15,000. And bad debts. The non-payment, risk of non-payment is given in the problem 12%. That is the bad debt loss. So 12% of sales, 36,000. So we are incurring two costs. One cost is collection cost, another cost is bad debt loss. So add up these two, 51,000 cost we are incurring by adopting the new policy. Whereas how much benefit we are getting? 1,20,000 is the benefit. Now we make a set off, trade off between benefit and cost. So net gain from the new liberalized policy is contribution minus the total cost. Contribution is 1,20,000 minus total cost is 51,000. So we are going to get a net gain of 69,000. So if the business adopt the new liberalized policy, the net gain will increase by 69,000 additional gain. So we suggest to the company to adopt this new policy because there will be a net gain of 69,000. So ultimate conclusion, it is suggested to adopt the new liberalized policy since the company will get an additional gain of 69,000. That's all. This is a simple first problem on evaluation of proposed credit policy. Now, second problem. See the second one. This is very important problem. ABC Limited is making sale of 13,50,000 with a credit period of 30 days. So presently the company is allowing 30 days credit period and the total sales are 13,50,000. In order to overcome the financial difficulties, it is considering to change the credit policy. The company wants to change the credit policy. The present policy 30 days, they want to change it. The proposed terms of credit and expected sales are as follows. Two policies are given, policy 1, policy 2. The proposed policy 1, the term is 45 days. That means we are lengthening the credit period. Presently 30 days, now they want to extend it and make it 45 days. If this happens, the expected sales will be 14,25,000. When we increase the credit period, the sales will also increase. The second proposed policy, make it 60 days. And the expected sales would be 15,50,000. Now present policy 30 days and present sales 13,50,000. Policy 1, if we adopt, the credit period will be given 45 days and the sales will be 14,25,000. If we adopt second proposed policy, 60 days period we are allowing and the total credit sales, the total sales will be 15,50,000. The firm has a variable cost of 80% and fixed cost of 1 lakh. In this problem, both the costs are given, fixed cost and variable cost. But one point you remember, the fixed cost will remain same whether we continue the present policy or we change it to policy 1 or policy 2. The fixed cost will remain same. The cost of capital is 15%. That means we are making investment in receivable. When we make investment in receivable, we want a cost of capital. The return we require is 15%. Evaluate the proposed policies and suggest which policy should be accepted. Assume number of days in a year as 360. For our calculation purpose, number of days we treat 360 days in a year. Now, we evaluate the proposed credit policy. The proposed credit policies are 2. Now see here, evaluation of proposed credit policy. 2 last proposed policies 1 and 2 and then 1 column for present policy. So totally 3 columns we require. First column is the present policy column. Apart from particulars, we want present policy column, then proposed policy 2 columns, policy 1 and policy 2. First of all, credit period. The present credit period is 30 days, whereas proposed credit period are 45 days first policy, 60 days second policy. Now we'll start our calculations. First of all, sales. Presently sales 13,50,000 given and the proposed policy sales 14,25,000 and 15,50,000 clearly given in the problem. Now we'll take the cost. We treat this as A. This sales we treat it as A. Then variable cost at the rate of 80% of sales given. So 80% of 13,50,000, 10,80,000. 80% of 14,25,000, you'll get 11,40,000. 80% of 15 lakh 50,000, you get 12 lakh 40,000. That is the variable cost. Now fixed cost 1 lakh rupees given and it will remain constant. Same. The fixed cost 1 lakh, 1 lakh, 1 lakh. Add up total cost 10 lakh 80,000 plus 1 lakh, 11 lakh 80,000. 11 lakh 40,000 plus 1 lakh, 12 lakh 40. 12 lakh 40 plus 1, 13 lakh 40,000. We got the total cost. This we treat it as B. A is the sales, B is the total cost. And we all know profit is sales minus total cost. Sales are 13 lakh 50,000, total cost are 11 lakh 80,000. So 13 lakh 50 minus 11 lakh 80, you will get 1 lakh 70,000 is the profit in the present policy. Whereas in the proposed policy, 14 lakh 25,000 minus 12 lakh 40,000, 1 lakh 85,000 is the profit. Second policy, 15 lakh 50,000 minus 13 lakh 40,000, 2 lakh 10,000. We got the profit in the present policy and also in the proposed policy. Now we need increase in profit. How much is the incremental profit we are going to get? So compare the proposed policy with present policy. Here 1,85,000 is the proposed profit from policy 1. Present policy is 1,70,000. So 185 minus 170, you will get 15,000. So increase in profit is from 170 to 185. So 15,000 is the profit. Similarly, 1,70,000 to 2,10,000, the incremental profit is 40,000. You can take 2,10,000 minus 170,000, you will get 40,000. 185,000 minus 170,000, it is 50,000. These are the increase in profit if we adopt proposed policy 1 or proposed policy 2. Now secondly, investment in receivables. We have to find out what is the return on investment in receivables. See, total cost we are incurring 11,80,000 for 1 year. But how much is the credit period we are allowing? 30 days. We want how much is the total cost for 30 days. It is given here for 1 year. So 11,80,000 into 30 by 360. You will get 98,333. How? 11,80,000 is the total cost for 1 year. But we want for 30 days. So 11,80,000 into 30 by 360. 98,333. First proposed policy 12,40,000. So 12,40,000 into 45 by 360, you will get 1,55,000. Similarly, last one 13,40,000 into 60 by 360, 60 days. So you will get 2,23,333. We got investment in receivables. Now we want additional investment in receivables. Presently our investment is 98,333. If we adopt first policy, the investment will become 155,000. That means our investment has increased. So we want what is the return on additional investment in receivables. So first we calculate additional investment in receivables. Presently 98,333. Here 155,000. So 1,55,000 minus 98,333, you will get 56,667. This is the additional investment in receivables in policy 1. In policy 2, 2,23,333 minus 98,333, you will get 1,25,000. So if we adopt first policy, we have to make additional investment of 56,667. If we adopt second policy, the additional investment in receivables is 1,25,000. Now in the problem it is given, the return we require on additional investment in receivable is at the rate of 15%. So return on additional investment in receivables at the rate of 15%. So 56,667 into 15%, you will get 8,500. Similarly, 1,25,000 into 15%, you will get 18,750. That's all. So we are having benefit and also we are having cost if we adopt the proposed policy. Now we make a trade-off, set off. We'll see how much is the benefit, how much is the cost in each of the proposed policy. Here trade-off. Benefit is increase in profit. How much is the increase in profit? 15,000 and 40,000. So increase in profit 15,000, 40,000. From that we deduct the cost we have to incur. Because we are borrowing the money and investing in receivables. So we have to pay to the borrowing cost. The borrowing cost is at the rate of 15%. So we have calculated 8,500. The cost is return on additional investment in receivable 8,500 and 18,750. Now benefit minus cost will get the net gain, right? So benefit 15,000, cost is 8,500. So 15,000 minus 8,500, 6,500 net gain we are going to get from policy 1. Similarly, 40,000 minus 18,750, you will get 21,250. That is a net gain from policy 2. Now compare it. Which policy we are getting more net gain? Second policy. 21,250 is the additional profit we are getting if we adopt policy number 2 of how many days? 60 days. So ultimately we suggest to the company to increase the credit period to 60 days. Then we are getting more net gain. So ultimate conclusion. It is suggested to adopt credit policy 2 of 60 days since the net gain in this policy is more, that is 21,250. This is the method of evaluating the proposed credit policy. So in this video, only 2 problems I have explained. In the coming video, 3 more problems I am going to explain so that you can get the basic knowledge about how to evaluate the proposed credit policy. In examination, you may get a theory question or you may get a problem. So if you get a problem, this is the method of solving the problem. So if you are understanding my lectures, give a like to the video, share my channel, subscribe if you have not yet subscribed, and in the comment write from which country you are watching the video and which university you belong, because my videos are being watched throughout the world in so many countries. I want to know from which country you are watching. And apart from that, you can join my membership club also, so that some exclusive videos I am going to make for exclusively for members. So inshallah we will continue the next problem in the next video.